Why use a structured installment sale for highly appreciated real estate? Selling highly appreciated real estate can come with significant tax implications, especially when dealing with capital gain taxes. Many property owners hesitant to sell due to concern about tax burden, but a structured installment sale offers a strategic solution to these challenges. So we will explore the advantages using a structured installment sale for highly appreciated real estate and why it can be a beneficial option for property owners. So first thing, let's talk about overcoming capital gain tax concerns. So delayed sale of main home. So if you have been postponing the sale of your main home due to capital gain tax concerns, a structured installment sale might be the answer you are looking for. So unlike investment properties, main homes are not eligible for 1031 exchange, making a structured installment sale more attractive as an alternative to defer or minimize capital gain tax liability. Plus, you can still use the primary home exclusion to exclude up to $500,000 for married filing jointly. So next up, let's talk about taxation of appreciated property sale. When selling appreciated real estate, understand the tax implication is crucial. So first thing, you want to calculate your capital gain tax liability. This is the difference between your cost basis and the net sale price represent your profit, which is subject to capital gain tax. So next up, we want to calculate the cost basis and the taxable gain. To determine your cost basis, you need to combine your purchase price with any improvement cost, subtracting your cost basis from purchase price and any applicable sales exclusion give you the taxable gain from the sale. For example, if you have lived in the property for at least 2 out of the last 5 years, you may be qualified for capital gain exclusion. Individual sellers can exclude up to $250,000 of profit, while married couple can exclude up to $500,000. Let's look at an example. Let's look at Mark and Lisa's property sale. Let's consider an example to illustrate our points. So Mark and Lisa bought their home 25 years ago for $200,000 and invested $50,000 in upgrades, bringing their cost basis to $250,000. So they're living in the appreciating San Francisco Bay Area, so they sold their home for $1.75 million, resulting in a profit of $1.5 million. After applying their $500,000 capital gain exclusion, Mark and Lisa are left with $1 million in taxable capital gains. With federal capital gain tax rate ranging from 0 to 20%, depending on the income and filing status, they are facing a 20% tax rate, amounting to $200,000. This is only on the federal side. Additionally, they must pay the 0.8% federal net investment income tax, NIIT, on their adjusted gross income that was over $250,000, adding another $38,000 to their tax bill. Also, they live in California. So as a California resident, Mark and Lisa are also subject to state tax, which is in their case amount to $113,000 of additional taxes. So we can look at the summary of capital gain tax liability here. So their total tax liability for federal with the capital gain 20%, the net investment income tax $38,000, and also California tax, the total tax liability is $351,000 on the $1 million gain. So more than 35% of your gain is going to taxes. So how can we turn the table and save them some more? So there comes the benefit of a structured installment sale. So the whole point is to defer and minimize the capital gains tax and then spread it out over multiple years, right? So a structured installment sale allows seller to spread the taxable gain over time, providing opportunity to defer or minimize capital gain tax liability. So this approach can be particularly beneficial for seller for the main home where 1031 exchanges are not applicable. So it gives you the financial flexibility. So it gives you a steady stream of income over time. And many times you can get interest too. So this is like additional income every year. So this predictable cash flow can be particularly beneficial for a retiree or a homeowner looking to supplement their income without the immediate burden of managing a large sum of money. Also, this method can help you attract buyers because structured installment sales can be attractive as it provides the fund as an alternative way of purchase the property, so the seller doesn't have to go to the bank, the traditional bank, because maybe they are not qualified because they have too many properties or their terms of the bank is not that beneficial to them compared to what you can offer. So, in our conclusion, structured installment sale of highly appreciated real estate, especially when it's highly appreciated, because if it's not highly appreciated, if it's completely covered by your primary home exclusion, like remember the $500K for manufacturing jointly and then the $250K, if it's less than that, so why bother, right? You can just use that and then it kind of wiped out your capital gains. But usually with highly appreciated assets, meaning it appreciates way more than that amount, and then you don't want to get hit like bam in the face during the first year, then installment sale might be the answer. So it's important you understand the in and out of installment sales and also consult your legal professional expert to understand the legal aspect of it and make sure that it's a great move for you financially and legally, and it fits your lifestyle. So I hope you enjoy the information. If you have questions, put it in the Q&A section. Thank you, and I see you at the next video. Bye.